Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Cushman Wakefield Limited annual report. Cushman Wakefield Limited offers a wide range of commercial real estate services across various regions. At the core of its offerings are integrated facilities management and property management services. These include client accounting, engineering and operations, lease compliance administration, project and development, tenant experience, residential property management, and sustainability services. The company also provides self-performed facility services such as janitorial, maintenance, critical environment management, landscaping, and office services. Additionally, it offers workplace and portfolio consulting services to help clients optimize their real estate portfolios. Furthermore, Cushman Wakefield Limited provides various capital market services including investment sales and equity, debt and structured financing for real estate purchase and sales transactions. The company also offers appraisal management, investment management, valuation advisory, portfolio advisory, diligence advisory, dispute analysis and litigation support, financial reporting, and property and/or portfolio valuation services. In terms of representation services, the company provides owner representation and tenant representation leasing services to clients. Overall, Cushman Wakefield Limited serves real estate owners and occupiers such as tenants, investors, and multinational companies with its comprehensive range of commercial real estate services. Cushman Wakefield Ltd's stock price has seen a significant increase of 15.34% over the past year, from February 2025 to February 2026. This growth can be attributed to several key factors that have contributed to investor confidence. The company's strong financial results announced in February 2026 were a major catalyst for this positive performance. Cushman Wakefield reported its highest fourth quarter and full-year revenue in the company's history, with a 9% increase in full-year revenue to $10.3 billion. The company also achieved significant adjusted earnings per share, EPS, growth of 34%, reaching $1.22. In addition to these financial results, Cushman Wakefield has made significant improvements in its cash flow generation and debt reduction. The company prepaid $300 million in debt, reducing its net leverage ratio from 3.8x at the end of 2024 to 2.9x by December 31, 2025. Furthermore, the company's momentum in key service lines has been a major driver of growth. Leasing revenue increased by 6%, 5% in local currency, driven by strong performance in the Americas and EMEA, reaching its highest quarterly level ever in Q4. Capital markets revenue saw its fifth consecutive quarter of double-digit year-over-year growth. The positive outlook for 2026, with anticipated revenue growth of 6%-8% and adjusted EPS growth of 15%-20%, has also instilled investor confidence. Analyst upgrades, such as Wall Street Zen's upgrade to a strong buy rating and Wolfe Research's upgrade to outperform, with a $19 target price, have further contributed to the stock price increase. Overall, these positive financial results and forward-looking statements have likely instilled investor confidence, contributing to Cushman Wakefield Ltd's stock price increase of 15.34% over the past year. Cushman Wakefield Limited market capitalization of $3 billion is significantly larger than the average industry peer of roughly $0 billion. This shows that Cushman Wakefield Limited holds a significant advantage in their industry. Cushman Wakefield Limited trades at a lower price-to-earnings ratio of 14 times and a higher price-to-book ratio of 1.56 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The leverage on the balance sheet appears elevated, with liabilities of 77% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. Although shareholder equity has increased, the share count has risen while revenue is declining. This raises concerns that equity growth may be driven by dilution rather than business performance. The sustainability of the business model remains unproven. The income statement shows that the company revenue have been declining annually even though operating income have been improving. Although the drop in revenue is concerning, we can tell that management have been able to reduce cost. The primary drivers of revenue growth or decline can be identified through an analysis of the provided data. Revenue growth was observed in 2025 compared to 2024, with a total increase of $541.9 million. The Americas region saw a 9% growth in revenue from 2024 to 2025, while EMEA and APAC regions experienced 13% and 18% growth, respectively. In contrast, revenue declined in 2024 compared to 2023 by $1.2 billion. The Americas region saw a 5% decline in revenue from 2023 to 2024, while EMEA and APAC regions experienced 8% and 7% declines, respectively. A closer look at the geographic breakdown reveals that the United States, Australia, and Singapore were among the countries with significant changes in revenue. The data also highlights the impact of contract assets and liabilities on revenue growth or decline. Short-term contract assets decreased by $4.8 million from 2023 to 2024, while non-current contract assets decreased by $5.7 million during the same period. However, contract liabilities increased by $36 million from 2023 to 2024. Overall, the primary drivers of revenue growth or decline appear to be regional variations in market demand and performance. The data suggests that certain regions, such as EMEA and APAC, experienced significant growth in revenue, while others, like the Americas region, saw declines. Net income experienced a significant decline between 2024 and 2025, decreasing by 33% from $131.3 million to $88.2 million. This drop was also reflected in the net income decrease of $43.1 million over the same period. However, it's worth noting that net income had previously increased from -$35.4 million in 2023 to $131.3 million in 2024. Despite the decline in net income, profit margins showed an improvement. The adjusted EBITDA margin increased by 46 basis points to 9.3% in 2025 compared to 2024. Additionally, profit margins rose from 2.17% in 2023 to 4.41% in 2025. This increase in profit margins suggests that the company was able to maintain profitability despite the decline in net income. The revenue growth of 14% in 2025 compared to 2024 indicates a positive trend for the company's top-line performance. However, this growth did not translate into increased net income, highlighting the challenges faced by the company in terms of cost management and efficiency. The company's financial performance indicates a consistent trend of generating positive operating cash flow. According to various sections of the report, the net cash provided by operating activities has been steadily increasing over the years. In 2025, this figure reached $340.4 million, marking an increase of $132.4 million from the previous year. This upward trajectory is evident in both 2023 and 2024 as well, with positive operating cash flow recorded in all 3 years. The reconciliation of net loss attributable to the parent company to net cash provided by operating activities also confirms that the company is generating positive operating cash flow. With a total operating cash flow of $2.9 billion in 2025, it is clear that the company's financial health is improving. This trend suggests that the company has been able to manage its expenses effectively and generate sufficient revenue to cover its operational costs, resulting in a positive operating cash flow. The company's debt level has undergone significant changes over the past few years. While there are mixed results, some notable decreases include a reduction of $314.7 million, minus 10.7%, in long-term debt on page 52, and a decrease from $2,939.6 million to $2,624.9 million in total long-term debt on page 75. However, the company's total debt level for 2025 is not provided. In terms of interest expenses, there has been a notable decrease. On page 34, it is mentioned that interest expense decreased by -6% in 2025 compared to 2024. Additionally, on page 73, it is stated that interest expenses decreased from $76.3 million in 2024 to $64.6 million in 2025. This indicates a reduction in the company's interest payments. Overall, while there are some mixed results, the data suggests that both debt level and interest expenses have changed significantly, with a general trend of decrease in these areas. The performance of various regions and segments within the company has been analyzed, revealing notable differences in their success. The Americas region stands out as a top performer, boasting the highest percentage of employees and achieving an impressive adjusted EBITDA of $480.8 million by 2025. In contrast, the APAC region also demonstrated strong performance, ranking second in terms of employee count and generating significant revenue through adjusted EBITDA of $75.4 million by 2025. These regions have clearly been driving growth for the company. On the other hand, the EMEA region struggled to keep pace with its counterparts, registering the lowest percentage of employees and a relatively low adjusted EBITDA of $100 million by 2025. This underperformance highlights areas where the company may need to focus on improvement strategies to boost growth in this region. Cushman & Wakefield's management is optimistic about the company's outlook and strategy. With its global presence spanning over 350 offices in nearly 60 countries, the company is well-positioned to meet increasing client demands through comprehensive global offerings. The company's focus on leveraging technology to improve services and efficiency is evident in its investment in early-stage property technology companies. The management believes that the resolution of claims and litigation will not have a material adverse effect on the company's financial position, results of operations, or liquidity. This suggests confidence in the company's ability to navigate potential risks and challenges. Furthermore, the diversified revenue streams, including leasing, capital markets, and valuation and advisory services, indicate a strategy to reduce dependence on any one area. The company's management is also focused on expanding into new markets and increasing its market share. This is evident from its global presence and comprehensive global offerings. Overall, Cushman & Wakefield's management appears to be committed to growth and development through strategic investments in technology and expansion into new markets. The company has made several strategic moves through acquisitions and divestitures. In terms of acquisitions, the most notable one was the 2014 purchase of DTZ Group from UGL Limited for an undisclosed amount. This acquisition is specifically mentioned on page 91. In addition to this major acquisition, there are mentions of other business combinations on pages 58 and 61, which are accounted for under ASC Topic 805, Business Combinations. However, no specific details are provided about these acquisitions. On the divestiture side, the company has sold 2 non-core services businesses in August 2024, as mentioned on page 28. These sales were recognized in 2024 and resulted in proceeds of $122.6 million in the third quarter of that year. The company's financial strategy has been focused on retaining earnings rather than distributing them to shareholders. According to the provided summary, there is no record of the company paying dividends in any of the mentioned pages, 19, 22, 80, and 100. This suggests that the company has chosen not to distribute its profits through dividend payments. Furthermore, there is no information available on share buybacks, indicating that the company has not utilized this method to return value to its shareholders. That concludes the financial summary for Cushman & Wakefield Limited. Feel free to comment below, and I will be happy to answer them when possible.